इसको डाउनलोड कर देना अपने लैपटॉप पे. ओके. And just see how it works. Okay, and then we can have shared notes next time. Okay, fine. ठीक है. So this is called, basically this is a presentation on public issues. How do companies raise money, and we'll be more focusing on the process of IPOs and FPOs or rights issues through the stock exchange. Okay, so companies can offer shares to the public through the stock exchange. But the first, like, talk about briefly about all kinds of ways through which the companies can raise money. The first one is equity financing, the first box. Second box is talks about the debt financing, then internal financing, and the fourth one talks about hybrid instruments, and the fifth is called alternate sources. So the first one, which is called the equity financing, so we have issuing shares. So that means the company can issue shares, okay, either through the process of an IPO or an FPO. So IPO is basically for the first time when a company which is not a listed company is issuing shares to the public, and thereafter the company gets listed on the stock exchange, and the shares can be bought and sold from the stock exchange. Okay, so many companies comes through an IPO in the last 1-2 years, you might have observed. So they are raising money through issuing IPO. Now IPO can be done for a new shares, or you can even sell your own existing shares of the company. Some promoters or some kind of large investors can offload their shares through a process of an IPO. Okay, so we'll understand that. And FPO is whenever the company is issuing shares subsequently after they have already done an IPO. So they need more money, so they can always issue shares to the public. Okay, so the second time or third time when they raise money, it's called FPO. Okay, then a private equity, where the companies which are not listed on the stock exchange. So there, they can, I'll talk about the, the private equity here. So just read this private equity, Akriti. So basically, private equity is, refers to basically investment in companies that are not listed on the public stock exchanges. Those companies which are not yet listed on the stock exchanges. So they offer the shares through the private equity, capitalist, and that, this money can be, invested by high net worth investors or institutional players who can put the money into these companies. And the whole process is that companies should grow because these companies are very small, okay, and or even if they are big, but if they want to grow their footprint, so they need more money. So and these companies are not listed on the stock exchange as yet. Okay, so so this is a process. Okay, so private equity. So similarly, venture capital. Just read this. Now, as we saw, the private equity is basically already a company which is listed, not listed, but it is already in existence, okay? And it is doing some business. But the venture capital is basically, again, it's a type of private equity, but it is only for an early stage or a startups, which have a high potential, and they're into some kind of emerging businesses or IT driven businesses or the businesses which are going to do well in future. Okay. So these are made by the venture capital firms or individual venture capitalists in exchange for equity. So that means, we give them equity and, they get some stake in the company. Okay. And then they, help the company to grow. Either they have some expertise in managing those companies, or they can help those companies to grow because they have some professional background. So we'll talk about that later on. Okay. So let's move on to, this thing. So private equity and venture capital. Then we have the rights issue. That means the company can issue shares which is already listed on the stock exchange, but it needs more money. So either it can go for an FPO or it can go for a right issue. As per the Companies Act 2013, any company which is listed on the stock exchange, they must first offer shares to their own shareholders. Okay, and that's called the right issue. If the existing shareholders, if they are not willing to give money to the company, then the company can go and issue shares to the public through an FPO process. But the existing shareholders, they should pass a special resolution in the meeting of the shareholders to, give the this thing go ahead to the company so that the company can go to for an FPO rather than a rights issue. Okay, so equity financing, issue of shares either through IPO, FPO, or a private equity where an unlisted company when they require money, so they can raise money through various forms. Okay, like venture capitalists, startup companies, and right issue. Already an existing company which is needs more money, so where the money can be raised from the existing shareholders. Then we have debt financing. That means company can take loans, okay, to from the banks or financial institutions. That can be one way. Second would be, company instead of taking a loan, or maybe after taking some loan, they can even issue debentures, which are called non-convertible debentures or convertible debentures, okay, or bonds. So if it is a debt financing, when we call it, debentures or bonds, or if it is for short-term purpose, like for a year or 6 months, then they can issue commercial papers, which are promissory notes, okay, which are again tradable, okay. So and then the third one is called the hybrid instruments, which is convertible debentures. That means initially they are like normal debentures which carries an interest, but then they can be converted into shares after some time. Okay, so these are called convertible. That's why they call hybrid, because they have both the equity as well as debt features. Then preference shares. Okay, preference shares, and then we have the mezzanine financing. So what is mezzanine financing? So we can just have a look at this slide to understand. Okay, just Akriti, can you read? So basically, it's a mezzanine financing. It is basically in between. It's a hybrid kind of a way of raising money. It has a features of both debt as well as equity. Okay, just like you have convertible debentures. So it is called mezzanine financing. Okay, it sits between the bank loans and the equity. So in terms of risk, it is less secure than the debt, which is obtained from the bank, but safer than the equity, because they will get the first right to get the money from the company in the event of liquidation or any kind of a problem. So it combines the features of both. Okay. So we'll talk about mezzanine more in detail later on. Okay. So let's go back to this thing. So we have, these hybrid instruments basically which have features of both debt and equity, like convertible debentures, preference shares, because you may get dividends, okay, and but they are not, like fully like equity shareholders, okay. Then we have internal financing, retained earnings or depreciation funds. Okay, retained earnings are basically companies when they earn money, which they don't, share with the, company is not going to give the dividends, but they're retaining those money, profits to, grow their companies. Okay, so these are called retained earnings, like, in form of general reserves. Okay, then we have depreciation funds. Now, how can depreciation fund be an internal financing? Anyone? Akriti? Depreciation fund is an internal financing. So how it is an internal financing, depreciation fund, if I ask you this? या बताओ बताओ. हाँ बताओ. आकृति. हाँ. Okay, okay. Okay, now I'll just tell you, how the depreciation fund is created. Whenever you buy an equipment, plant, machinery, okay, you depreciate them, isn't it? I mean, either on 10%, 20%, 30%, whatever is the rate of depreciation applicable as per the Companies Act, you're going to charge the depreciation. Okay. Now, depreciation is not a cash outflow, isn't it? It is basically, you are charging depreciation, reducing the profits of the company. Okay. But there is no cash which is going away from the company. It is there in the company. Okay. So depreciation funds always represent a cash which is lying with a company. Okay. So now that cash which is lying with the company can be used for any purpose, either for financing your new assets, okay, or paying, as you said, for repaying loans, or for buying into working capital or inventory or whatever, because your money is being used for so many purposes. Okay. So depreciation funds are basically, the money which is lying with the company, because though it has been charged to your profit loss account, but doesn't mean outflow of cash. So that money remains with the company. So either it will remain in as a cash and bank balance, or in form of new investments when the company makes, by putting money into various kinds of investments they are making. So because, then again it acts as an internal financing resource, isn't it? आखिरी समझ में आया आपको रितेश? अब्दुल? Because when the company is charging depreciation, it doesn't mean there is a cash outflow. So that money is remaining with the company. Okay, fine. Now company can use that money either for buying new equipments whenever the old, machines they become obsolete, or they have to be replaced by the new machines, equipments. So all this depreciation, which has been charged by the company over the years, that money sits in the company's books of account in various kinds of, either cash and bank balance or in form of investments. So that money can be used as an internal financing, isn't it? Okay. Then we have alternative sources. Yeah. Any questions? That's a very good question. Okay, Abdul, that's a wonderful question, because here the money is, there, and it may be lying in any form of an asset. It can be lying in form of a bank account balance. Okay, because since you have charged the depreciation and the money, there is no outflow of money, and you have not spent any money, so it will be always there in your bank account. Okay. Now, if you have actually, suppose if you have bought a new machine, the old machine has become obsolete. Okay, say after 1 or 2 years the machine become obsolete, so you're using a bank balance to buy a new equipment, okay, new machine. So then it has actually changes from the cash bank balance to the form of a new asset. Okay. Or suppose if you have money with you and you don't have any need to buy another equipment, because your already equipments you have, so you can invest that money in investments, like you can buy a mutual fund or a equity or any investments, or a fixed deposit. Sometimes the companies put the money in a fixed deposit, okay, for all the money which is not been in use, so they can park that money into various kinds of liquid mutual funds, or short duration mutual funds, or fixed deposits, or whatever form. Okay. Or if the money can be used even for financing your inventory, like the company needs money because it has to sell goods, so it has to buy certain goods to keep them as an inventory. So instead of raising that money from some other source, so company can use even the money which is they have, collected through way of depreciation funds, because that money is sitting with the company. So money can be used for whatever purpose they want. Okay, for whatever purpose the company requires, for growing their businesses, it can go to any form of investment. It is not that it is sitting on a reserve, or a retained reserves, or kind of a general reserve. It's a depreciation funds, unless you have created a separate account where you're parking all your depreciation money into that depreciation fund reserve, then the money will sit there. Okay. Yeah. Because all your cash bank and bank balances will reflect the money which has been created out of your profits, or created out of your depreciation fund. Okay. Now, some companies have a policy of putting this money into a depreciation account or a fund or a reserve, okay, where they will put this money so that they don't use this money for any other purpose rather than for only for buying new equipments. Okay, fine. So you can always, companies can always put this money and they into a separate account where they say that okay, we are going to use this money only for replacing existing assets whenever they become obsolete. Okay. अब अगर आप suppose Abdul, if you're doing a business and you have a lot of assets and you're depreciating them, money is not going anywhere. That money is remaining with your business. Now it is your prerogative that whether you use that money for buying replacing the old equipments whenever the old equipments become obsolete, or you can use them for temporarily for whatever business purposes you're doing. Okay, so there is no bar on that. Okay. Okay. Then we have alternate sources, crowdfunding. Okay. So let's go to the alternate sourcing. Okay. Just you can read this, क्या कहते हैं, आकृति, just the internal financing. So normally a company would always use, depreciation fund for the purpose of, buying new assets whenever they are replacing, or they can invest it, park it somewhere for some time. So whenever they need, they can always, put to use for buying new equipments. Then the hybrid instruments, which we have already done. Then we have alternate sources. Okay, read this. So, first is crowdfunding. Now, have you heard about crowdfunding? Any of you? Kriti, Ritesh? Suna ho hai na? Many of the students in, your college or your this thing university, they were raising money through the process of crowdfunding. There was a student in BMS. I just remember her name, Nandita Kaushik. She was, raising a lot of money through Facebook and channels for, for the dogs which are there in, your GNU, in your university. Okay. So because, those dogs, they were, feeding them and, treating them, as well as, giving to some people who can take them and, take them as a pet. So, there was a girl who was doing this kind of an NGO, and she was raising the money through crowdfunding. Then government grants and subsidies. Whenever you do business, you may get sometime incentives from the government. Like, if you are setting up a kind of a, a power plant using solar energy, so government gives you subsidies, grants. Like for many things, government can give grants. Okay, so those grants are not, they are non-repayable. That means you don't then return them to the government, but you can use those incentives for doing your business. Okay. Then strategic partnerships or joint ventures, like collaborations with where partners invest resources together. So you can always do kind of joint ventures or strategic partnerships. So where they can your partners can bring in money, okay, and you can carry on to do your business. So these are this thing. Now we come to the chapter, okay, the main chapter. Now, whenever a company issues shares, okay, it can go for a public issue, or it can go for a rights issue, or it can go for a preferential issue. Okay, fine. So if the company goes, now, what are the types of issues we have? Public. So it can be either a initial public offering or a FPO. So whenever a company, is issuing shares for the first time, it's still a unlisted company. So when it issues shares to go public, it's called IPO. So whenever a company is raising the money for the subsequent time after it has already done an IPO and needs more money, it's called FPO. Okay. Then the IPO and FPO can be done for two things: for new issue of shares or offer for sale. Okay. That means the promoters or big investors, they can offload their shares also through a process of an IPO. Okay. Uh, so is that clear, Akriti, Ritesh? Offer for sale means whenever a company is issuing shares, it can either issue new shares, okay, or it can offer already existing shares which they have, okay. so that the money doesn't go to the company, it goes to the shareholder. Okay. In case of an IPO, if it is done for a fresh issue, the money will come back to the company. Okay. And they can always, use that money for expanding their business. Whereas an offer for sale, the money will be going to the individual shareholder. Either it can be a promoter or he can be, an existing, a big shareholder. So money will go to him. Okay. Fine. Or the company can come for a right issue or a preferential issue. We'll talk about that later. Okay. So these are the people who are the regulators. Can you read, Akriti? So these are the regulators. These are the people who regulate. Now, because the money is taken by the companies, and company can, put that money for doing business, or they can even do some kind of a fraud. Like, we came to know about this Blue Smart. There was a taxi operator, which, have you read about that? Any one of you? So, yeah, Jaggi brothers, okay. So, they have actually raised a lot of money, and then the money was spent not only for buying, the new cars, but they have been bought for personal this thing also. So that's why, all these, kind of issues which, people are raising money either by way of debt or by way of equity. So this needs to be regulated. Now, again, in this case, Jaggi brother, who was the person who first noticed this kind of a fraud? SEBI, isn't it? Yeah, so it is the SEBI which came to know about this, which has happened. Okay, because so we'll understand what are the kinds of regulations which the SEBI or the Companies Act or the stock exchanges or the Reserve Bank of India, these are the regulators. Basically, they have framed lot of law so that the companies can't do any fraud. Now, frauds can be always done. Okay, but the idea is that the people should they should follow all the norms and regulations. So there's a very less chance of anybody committing a fraud or such kind of an event. But still, people are such, they can find always loopholes and I mean siphon away a lot of money of the public. So let's understand. Okay. So these are the various, like we have Companies Act, we have the stock exchanges. We have two major stock exchanges, Bombay Stock Exchange and a National Stock Exchange. Then we have the Reserve Bank of India. So these are the regulators of public issue. Now, what are the key regulations? Can you read, Akriti? Now, these are the three kinds of, regulations which governs the raising of money from the public. The first one is called the SEBI ICDR, Issue of Capital and Disclosure Requirements, which was, originally started way back in 2000. Then now it has become 2000 after a lot of amendments which has taken place, and it's called now SEBI ICDR regulations. So most of the time we'll be focusing and understanding what are the rules and regulations which has been put by SEBI under this regulations. Then we have the SEBI listing obligations. No, we all know that companies, once they issue shares, they need to be listed on either Bombay Stock Exchange or National Stock Exchange. Okay, so they need to follow certain norms of listing. Okay, they have to do a lot of disclosures. So every quarterly they are supposed to declare their performance, like how much money, how much profit they have made. They have to publish their balance sheets and everything. So these are all contained under basically the LODR. So there are two kinds of regulation. One is called the ICDR, another is called the LODR. Okay. So the third one is called the Companies Act 2013. Just a sec, I'm just coming in a half a minute, okay?